What's going on, cash flow hackers? It's Chris. This video, we're going to be talking about whole life insurance and why and how whole life insurance has developed this reputation for being a ripoff, right? You get people like Dave Ramsey and Suze Orman that will tell you that whole life insurance is an absolute ripoff.
Life does not grow tax-free unless you lose money. Well, because the product is crap. If you take a $200 whole life premium, I can buy the same amount of term insurance on that 30-year-old for about $10.
If you buy it, you're an idiot. If you sell it, you're a scam artist. You're a snake oil salesman. And ultimately, you have people on the other side, like me, and like plenty of other wildly successful people. Heck, banks, corporations are all putting their money into whole life insurance, and they believe that it's a good asset. So the question is, what's the truth? And what has led to whole life insurance gaining a reputation of being a ripoff? Now, I will say this. I fully agree with the fact that whole life insurance has made its bed. It's really tough when you get into this business. Admitting you're a salesperson that sells life insurance is the equivalent of like being a used car salesman, right? Like it's just like nobody trusts you. It's kind of icky, right? Like in a lot of ways, like people just kind of feel icky about talking about life insurance. I mean, there's elements of life insurance is not a fun thing to talk about. Mortality isn't a fun thing to have a conversation about. But I really think it's a lack of understanding about how these things work. And when we start to understand and we dive deep about what has led to these results, why whole life insurance has built, it has kind of earned its bad reputation, I should say, over the past maybe 4 decades, and why I think that now, if we look at the past and we look at where we are and we look at where we're going, why the future looks wildly different than the performance of the past 40 years, and where the opportunity is for people. Because I believe that being a life insurance agent is one of the most noble professions that we can do. I don't think there's another industry out there where you can make money purely based on value creation for other people. And you know, when you look at that, it's also really hard because there are also ways that you can take advantage of people, and you know, people can get ripped off, and I see it all the time with poor product designs and poor product selection. And these are the things that are really challenging. So in this video, what I'm going to do is I'm going to go through a little bit of a history here and show you why whole life has earned its bad reputation, and ultimately why Dave Ramsey is almost justified in his opinion of whole life being a ripoff. Now, I'm going to talk about this more as we go. So if you look here, I pulled up this board, and I wanted to do this. I got 10-year treasury yields on securities, and then I got the federal funds effective rate that I did 2 charts. And you can see it doesn't show here, but I did 1980 to present time, 1980 to present time on both charts, okay? I think this went to 2024 because 2025, obviously, this is a year-by-year chart on the yield, and this is a month-by-month chart on the federal funds effective rate. So that's why it's got 2025 in there, because obviously we got a couple months into 2025. And so that said, this is the situation. Let's go back into time and talk about Dave Ramsey and talk about when he started his business and when he had his experience. So when he's sharing his experience, if you've ever heard a story about, you know, real estate and losing everything and having all these times, when was it? It was right about this time, this window right here, right? And so when we look at Dave Ramsey and his story in this window right here, what's happening right now? We have to look at this. We have rates dropping, going down. The 10-year treasury yield is dropping. We have the federal funds rate all over the map, going down, going up, but ultimately dropping, going from probably an average of north of 10%. Probably, you know, you see rates going up as high as 19% here, but 1985 right here, we're still at 10% federal funds rate. So this whole time, with the exception of this little blip right here and here where it dipped down for a couple months, we're over 10% for the federal funds rate. What does that mean? That means from then going down, we are reducing in performance from a federal funds rate perspective. It's not even reducing performance. They are lowering the cost of money, and they are stimulating the economy. Because remember, we had inflation issues in the 70s. They jacked inflation or the federal funds rate up to control inflation, and then we got to ride the wave of ride down the hill of declining interest rates. And when interest rates go down, asset prices go up. That's just what happens. And so a lot of the real estate boom is due to the fact that mortgage rates were up here and now they're down here. That just is what it is. And they've spiked up a little bit. And I realize that prices have kind of bucked the traditional trend and not gone down significantly when rates went up here. But the bottom line is that's a supply-demand issue, and I think that will sort itself over time, and I believe we will still have a real estate correction. That's just my take on the situation. I don't know how you feel, but that is how I feel. So when we look at this, though, I don't mean to do that. When we look at this, when interest rates go down, assets go up. Right? So when interest rates go down, asset prices go up. And when historically, when asset prices or interest rates go up, asset prices tend to come down. Why? Because when we think about a mortgage, right? When we think about a house, we buy a 30-year mortgage on that house. And let's say I buy a $500,000 house today. If I buy a $500,000 house, let's just say I'm buying that house. Well, I'll share. Well, I don't have any numbers in this. Let's say we got a $500,000 house. Right now at a couple of years ago at 3.5%. Okay, you buy that at 3.5%. Of course, the market goes up. Well, what does this happen? Let's just call this $2,600 per month is what you wind up paying for this house, all in, on a 30-year mortgage, okay? Now, if this rate then goes away and that rate goes to 7, what is this rate on the house at that point in time? That's probably going to go to something like, I don't know, $4,000 a month or something like that. Okay? So the question is, what is this house worth? Is it worth $5,000 or $500,000, or is it worth $2,600 a month or $4,000 a month? That's the question. And so I'm not saying this about real estate. That's not what this video is about. But what I wanted to convey there is the fact that when you look at how interest rates work and what it does to asset prices, what it does to expectations, he's looking at it through this lens. And when he built his whole mindset on asset prices, he did it during this huge bull run period. And he would say you could get 12% returns in a mutual fund. Well, maybe for a little window from 1980 to 1999, the S&P 500 averaged 13%. Okay, that's fine. That's a 20-year window. If you take that 20-year return out of the past 120 years of the market returns, well, the average market return is just over 6%. So when you think about the fact that that 20-year period is this anomaly that was created by high interest rates that went down, that was created by the fact that, oh yeah, by the way, 401ks were created right at this window in 1981, effectively. It was actually 1979 to 1982 is when they became more popularized, but 1981 is when they kind of started hitting some traction, right? So it was the perfect storm for the economy to have this 20-year bull run, and that's what led to the dot-com boom, along with a bunch of other stuff. But when you look at this, the fact that we had high interest rates, the fact that everybody who is in a qualified plan now getting into the qualified plan space there that was just introduced was coming into this market, and the fact that interest rates were going down, well, it was the perfect storm because interest rates were going down, which naturally stimulates the economy. We had a bunch of people flooding in, and so that's like more people buying more assets. It's a supply and demand thing. There's not an unlimited amount of stocks available, so that drives prices up. So what happens is this whole storm created this massive growth wave from 1980 to 2000, 1999, right? And so I say all that because I'm trying to get behind the mind of somebody like Dave Ramsey, who says whole life insurance is horrible, and I honestly don't think he believes it anymore. I think what happened is it wasn't horrible, but I will say that whole life insurance, while it's not horrible, it was horribly sold. And believe it or not, whole life insurance in the 80s was sold very similarly to the way the IUL is sold today. What do I mean by that? I mean, how do you figure this out? Let me see here. I'm gonna put this up here and say, all right, when you look at a whole life illustration, there's two things that happen on these illustrations. There's a guaranteed, you have the guarantees, and then you have the non-guarantees, right? And so there's a divide between those two. And so when we look at the guarantees, we have to say, all right, what are those guarantees? Now in the 80s, the guarantees were 4%, okay? The guarantees are 4%. Now the non-guarantees look at two variables. They look at the fact that A, the company is going to pays a dividend. And then secondly, the dividend is at the current rate. Okay? So when we look at this, let's go back here. This green line that I have written right here. This is, I mean, it's not completely accurate. Obviously, it's my chicken scratch, but it kind of follows a trend on where dividend rates were, because you could see here as I kind of go, this is the green line I'm talking about, right? And so what happens is dividend rates chase interest rates, and they go up. And as you could see, the interest rates went up higher right here faster, and then the dividend rates chased up, and there was a crossover point. And then as rates went down, they chased them down and they flattened out because life insurance companies invest for the long term. They're investing in 30-year bonds. It's important to understand that in this window, if we looked at the 60s and 70s, what's important to know, and I'm just going to kind of bounce this out here, is that this is what the interest rate, actually, I'm going to do it in blue just to keep things kind of similar, right? So in the 60s, 70s, and it went all the way down here, kind of like we are now in 1940, I think it was 8 through like 1955. Interest rates were super low. We're in like the 1.5 to 2% range coming out of World War II and being in that world to stem the economy. So you can see this. We had this big wave up, and then this big wave down. And this is the cycle this is the economic cycle that we're in, interest rate cycle that we go through. Now here, interest rates, the dividend rates went up because when insurance actuaries and general account managers, they know in these insurance companies, when they have the ability to lock in these high rates, they put in and they invested for as long term as possible, and they bought 30-year bonds in this window. From 1980 to 1985, 1990, when these rates were at historical highs, even through 1990, the 80s were the booming years for life insurance companies to buy these bonds and to be able to like give stability to the general fund performance. And that's one of the reasons why, even though we see the federal funds rate being at zero and being low, the dividend rate still stayed, for the most part, in the 6 to 6.5 to 7% range up until like right about here in the late 2000s. And then it dropped into the low sixes. And then ultimately in 2018, 19, 20, it dropped into the mid fives, low fives. And now it's bouncing up into the upper fives and low sixes. That's kind of where we are again, right? But this is a wave. And so I'm not saying that we're going to hit the wave going way back up here again, but I am saying we are seeing rates come up. And when we understand now, that you understand that, we understand that the dividend is paid at the current rate. Now imagine, let's take a time machine, let's hop in our DeLorean and let's go back to 1955 with, Marty McFly. And as we go back there, let's think in 1985, when Dave Ramsey was formulating his opinions, what was happening? people were buying whole life that was illustrating with a 12% plus dividend rate or so. Okay? Maybe it was 10%, maybe it was 12, but you get the point, right? If you were running an illustration with that, you know how awesome the numbers are going to look on that illustration? It would be really easy to go in there and sell on how these whole life illustrations are going to perform. It would sell. This is very similar to how IULs are sold right now. They're sold based on these illustrations that don't really mean anything. That they're basically worthless. They're the equivalent of toilet paper once you sign on the dotted line. And the challenge is, if you bought a whole life policy with a 12% dividend rate or 10% dividend rate, 9% dividend rate, it's showing on the illustration that you're going to have this current dividend rate every single year during the length of the policy. So what happens is, if dividend rates go down and you're looking at your policy illustration that you bought with the policy, and the dividend rate over a 15-year period, 20-year period, 30-year period goes from 12 to 11 to 10 to 9 to 8 to 7 to 6 to 5.75, where we are now, or 5.25, and then back up to 5.75 and maybe 6. Well, it's going to pale in comparison to what you originally bought. So, of course, people are going to come out there and say, like Dave Ramsey, and say, well, this is a horrible product. Why would you ever use this? Well, it's because this product, it's about understanding it. Because when you look at whole life insurance and you look at the dividend rates, right? The reason I included the bond rate here is because you could see with the federal funds rate, whole life insurance is a fixed asset. We can't compare it to an investment. Dave Ramsey loves to compare whole life to investments. And he built his formula of 12% returns that he says people can get, which to me should be criminal for even saying, because that's like the worst advice I've ever heard. But he says it nonetheless and doesn't get in trouble for it. But when we look at the dividend rates, we got to compare it to bond rates. And bonds and whole life solve different problems. In fact, whole life insurance, I would argue, and my buddy Tom Wall argues, whole life insurance is simply a better bond. That's it. Because you get bond-like returns over a long period of time, you get additional benefits, and you get no standard deviation. You don't have any risk of losing money, whereas in bond return funds, you can lose money. And when bonds, when rates change, when bond prices go up, like if you're buying bonds right now and bonds go up, you're actually losing on your bonds because nobody wants to buy the old bonds, right? So you can lose money on bonds, but what happens is when you put your money with a whole life insurance company, you are letting them manage that risk, and they take it on and they eat the losses and pass it through the company, and you are partnering with them on that. That's the important thing to understand. Now, I can defend whole life insurance companies all day long and explain to you why it works, but the point of this video is to say whole life insurance agents during this window of time, I'm going to say 1995 all the way back to 1980, they built this reputation. And of course, that was when people like Dave Ramsey and Suze Orman started to get popular. And when they built this reputation and A.L. Williams, another one, started ripping on whole life insurance for being the worst product, the biggest ripoff, it's because agents were selling these products based on these current rates and the assumptions in the illustration, and they were selling them as if they were factual. They were selling them as if that was going to be the way the policy performed. Very similarly, once again, to how IUL agents are selling IUL using illustrations today. You should never buy a whole life policy or an IUL based on the illustration. You got to buy it based on the principles and understanding how it works. Now, when I look at this right now, I look at where we are, and if I look at it principally and I look at an illustration, I look at rates right now, we're near the bottom dividend rates that we've had in almost 90 years in the life insurance space. So when I look at it through the lens of what's the upside, what's the downside, can I live with the downside? Well, if interest rates, the current rate now is near the lowest, well, we can look at it with a level of confidence, a degree of confidence that it's going to perform kind of in a worst case scenario, pretty close to what the current illustrations are. Now, sure, there's some downside potential if interest rates go down, and there's that risk. But to me, that risk is far less now than it was back then. And if anything, my personal belief, and obviously there's no guarantees here, but my personal belief is that I think rates will go up. And I think when rates do go up, history says, or the federal funds rate will go up. And as rates go up in the federal funds rate, I think history always has shown for almost 200 years that dividend rates always follow the fixed market environment, right? And so even though whole life has earned its bad reputation because of the illicit sales activities and bad illustration tactics and people not understanding what they're actually buying and what problems they're trying to solve with it, they realize that if you're in this environment and you understand what you're getting involved with and you understand the problems that you're trying to solve and you understand the fact that we are in a completely inverse environment and what you have to do, by the way, to earn money, to be successful, to make your money work for you in an increasing rate environment is wildly different than what you do in a decreasing environment. And that is the power. And having, in fact, in a decreasing environment, this is where people became bond kings, right? And they made a lot of money because interest rates are going down. And if interest rates are dropping like that, it's making money in bonds, and being a bond trader is one of the easiest things to do. Making money when interest rates are going up in the bond market, and make no mistake about it, the bond market is a key foundational part of our economy. Making money in an increasing environment in the bond market and with bond funds and managing the safe portion of your portfolio is infinitely harder in an increasing rate environment. And that makes the power of whole life insurance even that much more powerful, because the standard deviation, the risk, the variance that goes into bond markets, the insurance company eats and manages it along with the rest of their portfolio. So that's why it is a better bond. Hopefully that made sense. If you have any questions, I would love to hear your feedback. Was there something in this video that stood out to you? Please leave me a comment. Like and share this video. Get it out there. Subscribe and hit the bell. That way you are notified every time I launch a new video. If you found value in this, please give me a heads up in the comments. It helps grow the channel. Would really appreciate it. Hopefully you found value. Until next time, have a blessed, inspirational day. Talk soon.